Hi students, so welcome dito sa ating first discussion which is partnership formation. Okay, so let's start our discussion. So for partnership formation, our focus points or our objectives. First, we have to define partnership, then characterize partnership, then third, know the core concept of a partnership, then next, to know the partner's ledger accounts, and last, to account for partnership formation. Okay? So let's start with the definition of partnership. So what is partnership? Partnership, based on Article 1767 of the Partnership Law, by the contract of partnership, two or more persons bind themselves to contribute money, property, or industry to a common fund with the intention of dividing the profits among themselves. So take note of that definition. So based on the definition, you may ask what are the essential factors in forming partnership. Okay, do we need that? Yes. Do we need to know? We need to know the essential factors of a partnership. So partnership, there must be association of two or more person. So minimum for a partnership, there must be two person because if only one person, then it's not partnership. It is sole proprietorship. You have tackled your sole proprietorship in your basic accounting and enhancement na subject. Okay? So at least two uh, association of persons. So it could either be more than two. Okay, so association of two or more person. Next, we have it. There must be co-ownership among the partners over the partnership fund. When we say co-ownership of the partnership funds, referring to the investment or the contributions of the partners. Meaning, if someone has invested cash, someone had invested car or other non-cash properties, okay, those properties or those cash is uh, not owned by specific partner, but they are owned by the partners themselves. There is co-ownership over the partnership fund. Okay. By the way, in the partnership, you can either invest cash, you can invest non-cash assets or properties, and you can even invest if you don't have cash or properties. You can invest your skills or talents if you have. If that is hidden, you must dig it up. You must find that talent in any way. Next is the business is for profit and there must be division of profit. Of course, if we are setting up for business, it is always the main target to earn profit. It is only natural for a business to incur losses, but incurring losses is not the objective. The objective is for profit. Okay, sir, but is it really natural to incur loss? Yes. There are some times that business incur loss, but again, incurring loss is not always the objective. Okay, so it must be for profit, and if the partnership business is for profit, it earned profit, there must be division of profit. So to characterize partnership based on what we have in the essential factors and the essential definition, then we can have partnership as partnership as juridical personality separate from the partners. Okay, when we say separate personality, meaning if four person agreed to form partnership, the total personalities that we can have is five personalities. So how come only four have formed partnership? How come there are five personalities? Okay, so um if Nana, Nene, Nini, and Nono make partnership, there are four natural persons and one juridical personality. That becomes five. Okay? The fifth personality is the juridical personality, which is the partnership. So the partnership will be included in the counting of total personalities in the partnership. Okay? Next is partnership can easily be formed. It can be created through oral or written agreement. So by mere word of mouth, or if you don't trust the agreement by word of mouth, you can have it written. So partnership can be created through agreement. So by agreeing that you are to form partnership, as long as there is trust and confidence between the two of you, then partnership is created. Partners are co-owns the partnerships, the assets and profits. As I have told you earlier, okay, they are co-owners of everything in the partnership, either asset or profits. Partnership has limited life. It can be terminated by the partners anytime. Since it is through agreement, okay, the formation of the partnership is through agreement, okay, the birth of a partnership is through agreement, then the death or the termination of the partnership can be through agreement. That is why it has limited life. So if we form partnership today, if some people form partnership today, they can terminate the partnership after how many days, or weeks, or months, or how many years. Okay, it is dependent on their agreement. Partnership has mutual agency. All partners are agents of the partnership, meaning all of the partners in the partnership can act in favor of the partnership or in behalf of the partnership. Then partnership has unlimited liability. Partners may still be liable of their personal properties. Especially if the partnership is so-called general partnership, then all of the partners are liable up to their personal asset. Okay? That is why partnership has unlimited liabilities. If the assets of the partnership can no longer suffice in covering those liabilities, then those creditors or to whom the partnership has debts, then they can run after the personal assets of each partner. So to sum it up, characteristics of a partnership, there must be association of two or more persons. It can be created easily through agreement. There must be co-ownership, limited lifespan, and there must be mutual agency, and it has unlimited liabilities. Okay, let's proceed with core concept. Maybe you are wondering what's the core concept of a partnership. I have already told you earlier what's the core concept of a partnership. Okay, so let's play a four pigs, one word. I know you are fond of this game. So the core concept of a partnership may be defined by these four uh, pictures or photos. Four picks one word. Guess the word. We can have it 1, 2, 3, 4, 5, 6, 7, 9 letters. You have 10 seconds to guess the word. 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. Have you guessed the word? Okay. I know you got it. The term or the word is agreement. Partnership is always about agreement between or among the partners. Because if there is no agreement, there is no partnership. As long as there is trust and confidence and the partners agree that they are to form partnership, then partnership is formed. Partners ledger accounts. Let's move forward with partners ledger accounts. Before we proceed with partnership formation. So partners ledger accounts, we need to know this one because there are some ledger accounts that are a bit different with that of the sole proprietorship. No need to discuss specifically the concept into assets and other asset accounts and liabilities accounts of a partnership because they are just the same with that of the sole proprietorship. But in addition to a partnership, that's why we are talking about ledger accounts, partners ledger accounts. We need to um, look into at least these accounts, be familiar with this one. So let's start with the comparison. So sole proprietorship versus partnership. As to asset, again, general accounts, they have it the same. But in addition to partnership, there is a so-called loan to partners account. Okay, it is a receivable account, meaning the partnership parang nagpautang doon. Okay, extended something or lend something to a specific partner. Okay, so the partnership is a receivable to a specific partner. As to liabilities, the same. They have general accounts that are being maintained, but in addition to partnership, partnership maintains another specific account which is loan from partners. Meaning, a specific partner, parang pinautang niya yung partnership. Okay? A specific partner lends something to the partnership. So it is a payable account. As to equity account or referring to the capital accounts, then they are different also in actually in accounting. So for sole proprietorship, we have the term owners. Okay, owners capital, owners drawings. But for partnership, we have partners capital and partners drawings. Okay, so to sum it up, partners ledger accounts that we have to focus more is on defining and getting to know partners capital, partners drawings, loan to partners, and loan from partners. Okay, so let's start with partners capital account. Okay, if you can remember your basic accounting equation, asset is equals to liabilities plus equity. Asset is always debited, normal balance is debit. Um, Liabilities, normal balance is credit. The same goes with the capital or equity accounts. We have it credit. For partners capital account, we always have it normal balance as credit. Meaning to increase the capital account, we always credit the capital. Okay? Then to deduct the balance or yeah, to decrease the balance of the capital account, we have it debited. Okay? So the partner's capital account is credited for original investment. When you say original investment, it is the original contribution to the partnership. Then next is additional investment. When we say additional investment, additional contribution to what you have contributed. Okay, originally contributed. Then another one is share in the net profit. If the partnership earns profit, since it is the goal to divide the profit among themselves, among the partners, then share in the profit is credited to capital account. Okay. The next is uh, it is debited for closing of drawing balance. It actually specifically referring to temporary drawings, which is being maintained uh, in the partners drawing account. Later, we're going to discuss partners drawing account. Okay, so temporary drawings, they are being maintained in a drawing account, temporary drawing account. Then afterwards, that partner's drawing account will be closed to capital account. Then it is also debited to permanent withdrawals. In contrast with temporary drawings or temporary withdrawals, permanent withdrawals are no longer maintained in a withdrawal account. Rather, they are being credited directly to debited directly to capital account. Then, of course, okay, in contrast with the profit, a net loss is being charged as a debit to the capital account, therefore decreasing the capital account. So, as a summary, if we're going to put it into a T account, okay, so a partner's capital is shown like this one. Okay, so on the debit side, we have the drawings, the withdrawals, and the shared net loss. And on the credit, we have the original investments, okay, the additional investment, and the share in profit. Next, we have the partner's drawing. When I say partner's drawing, we're actually referring here for the temporary drawings. The normal balance is debit. So it is a contra capital account or a contra equity account. It is against or charged against the capital account at a later accounting. Okay? So it is being temporarily maintained. Okay? It is being debited for temporary or common withdrawals. When we say common withdrawals, it is in anticipation of profit. So if the partners anticipates profit, they can withdraw temporarily in advance. It is being charged to a partner's drawing account. Then it is also debited to partner's claim and funds collected, okay, and retained by the partners. So if there are claims that had been collected by the partners, it is being treated as a withdrawal. Okay, partnership claims. So if a partners collected something which refers to partnership claims and partnership funds, then the partner can keep it. then the partnership can charge it as a drawing. Okay? Then also, it is being debited for partners' personal obligations assumed and paid by the partnership. So if there is a personal obligation that had been shouldered, not assumed, but just shouldered by the partnership, okay, then the partnership can treat it as withdrawal. Right? And it is credited. Okay, when we credit uh, earlier, when we debit drawings, we increase the drawings account. When we credit drawings account, we have it to deduct the balance of the drawings account. So it is credited for partnership obligations assumed and paid by the partnership, meaning it's like it's being offsetted what we have earlier in the debit side. Okay, so if a partner collected something related to funds or claims of the partnership, drawings account is debited. But if the partnership obligation is being paid by a specific partner, then we have to credit the partner's drawing. Then personal funds of the personal claims of the partner or funds collected by the partnership, then kine-credit yung partner's drawing. It's like parang baliktaran lang. Okay? Baliktaran lang. Second to the last bullet of the debited part, then this credited part here, pambaliktaran lang kanina. Then it is also credited, I mean, after being maintained temporarily, it is closed to a capital account every end of the reporting period. Okay, so a partner's drawing again temporarily being maintained. Okay, after the accounting, uh, it is being closed. When you say closed, it is being charged against the capital account. Okay, so to summarize, to sum it up, if you have it in a capital in a T account, so partner's drawing in the debit side, we have the temporary withdrawals, increase it. Then the claims of the partnership retained by the partner, then the personal obligation of the partner assumed by the partner, paid by the partnership. Then it is credited for partnership obligations paid by the partner, then credited for partners' personal claims and funds collected by the partnership. Then we have loans to partners. The use of the loan to partners account is something like, for example, there's a scenario that a partner is trying to withdraw substantial amount from the partnership. Instead of having it in the uh, instead of decreasing the capital account, okay, yeah, instead of having it as a substantial withdrawal, the partnership set up receivable account from the partner. So the capital account is being maintained as is, but a receivable account is being maintained or set up. That is the loan to partners account. Loan to partners account means as if the partnership is lending something to the partner. Okay? So the capital is being untouched, it's not being deducted or decreased, but an asset account is being maintained. That's loan to partners. So take note, loan to partners is something as if the partnership is lending something to a specific partner. The partnership is lending something to the specific partner. So loan to partners is a receivable, it is an asset account. Then loan from partners, kabaliktaran, it is a payable account. Instead of having a transaction as a substantial advances, okay, instead of having it as additional investment, let's say additional investment, what the partnership do is to set up a payable. So the capital account is being maintained as is, not increased by the additional investment. Rather, a liability account is being maintained, which is loan from partners. A loan from partners account is as if the partner, a specific partner is lending something to the partnership. Okay? If loan to partners is somewhat as if the partnership is lending something to a specific partner, then loan to partners or loan from partners is as if the partner, a specific partner, is lending something to the partnership. Baliktaran. Okay? Vice versa. Okay? So let's proceed now with the very core of our discussion, which is the partnership formation. Uh, all the partners ledger accounts will later be used or discussed more when we engage to partnership operations. However, the capital account, the partner's capital account uh, will be used here in our discussion for partnership formation. So what is partnership formation? Partnership formation is actually the first step or the first stage in the accounting for partnership. So who can form partnership? That's the question. Who can form partnership? Okay, so only natural persons, strictly by sense and nature, may enter into partnership. What does it mean? Natural na person, ikaw. Ako, ikaw, sila, tayo, tayo na lang. Mali. Mali pala, sorry. Natural persons, natural na tao. Okay? Natural na tao. So meaning, if it is a juridical personality like other large businesses, they cannot engage into partnership because the law provides only natural person. Okay? They can engage into partnership, but it will not be called partnership. It is a different term. Maybe control or joint arrangement, joint venture, but other than partnership. Because partnership, by strict sense, only for natural person. The combination of formation of natural person, I could either be two individuals, meaning uh, no business, talagang, ano, normal individual. It could either be individual and a sole proprietor, meaning a specific individual is forming a partnership with a business person or a business owner. Then last is two sole proprietors, meaning two business owners are combining into one business, forming partnership. Okay? What can be invested? Of course, any asset or any investment, including expertise. Okay? So we can have it money or the cash investment. Next is non-cash investment. We have the properties. Then if you have hidden talents, don't have it very hidden so that you can access those talents. You have skills, okay? You can refer it to your expertise or industry. You can still invest that in the partnership. Okay? Question. Can liabilities be invested? If asset can be invested, can liabilities be invested? Basically, no. No. However, partners can agree instead not to invest but to assume liabilities. If assets are invested, liabilities are not invested but assumed. The term is assumed. Okay? In order for a personal obligation of a partner be assumed by the partnership, there must be agreement among the partners that such personal obligation or liability be assumed by the partnership at the moment of formation. If there is no agreement, then such liabilities will not be assumed by the partnership. Then the specific partner will solely be liable for that obligation. Okay, so take note of that. Later, we're going to apply it in our problem solving. Huwag kang atat. Charot. So how do we measure investment? Okay, so here comes the application in accounting. How do we measure investment? For cash investment, uh, we measure cash investment at the face value. When we say face value, actual value of the money. If you don't, we still don't know what is face value, just look at my face. Joke. So face value, when we say face value, actual value of the money. If it is 1 million, then have it 1 million. Okay, no more, no less. Non-cash investment, for non-cash investment are the properties. We value non-cash investment at agreed value. Okay, always agreed value. When we say agreed value, uh, based on the agreement of the partners. Partners can agree either at fair value or market value or book value. Fair value or fair market value, they're just the same. Then at the other valuation is book value. When you say fair value, the value that we can have when we refer to the market. If we say book value, it is the value that we have in our own records. Industry, service, or expertise, we cannot measure it at the moment of formation. Okay? Immeasurable yan. Your hidden talents cannot be measured easily. Especially if it's really hidden. Okay? Joke lang. So partnership formation, let's start with two individuals. Okay? Two individuals are engaging in uh, partnership formation. So let's start with cash investment. Megatron and Starscream. Wow, parang transformer to. Formed a partnership, each invested cash in the amount 150,000 and 250,000 respectively. So meaning si Megatron nag-invest na 150,000, then 250,000 naman kay Starscream. Okay, they formed partnership, they only invested cash. The requirement is journal entry. So our necessary solution for this one, always take note, cash investment is always at face value or actual value. Tignan mo lang mukha ko. Okay? So, for Megatron's investment, kanyang cash investment, 150,000. Starscream investment, 250,000. Total investment, 400,000. No liabilities assumed, only asset investment. So, our journal entry, debit cash for total of 400,000. Then, credit, Megatron capital, 450,000. And Starstream capital, 250,000. Total assets, 400,000. No liabilities assumed. So total capital is 400,000. Okay? Next, non-cash investment with agreed value. Again, Megatron and Starscream formed a partnership. Megatron invested cash in the amount of 150,000 and Starscream invested his land with fair value of 250,000 and book value of 200,000. Then, pinaka-importante ang last statement. When it comes to valuation of the properties, the partners agreed to value the land at fair value. So, by that statement, pera na si book value. Disregard na si book value. So, the journal entries being required for the formation. Necessary solution is cash investment, always at face value. Laging tandaan yan. Non-cash investment, always at agreed value. But because the partner agree, Megatron and Starscream agreed to value it at fair value, we use fair value. So Megatron's cash, 150,000 at face value. Then Starscream's land at fair value 250,000. Total investment 400,000. So journal entry with debit cash 150,000. Yun lang naman yung cash. Then debit land for 250,000 kasi yun naman yung fair value, which is the assumed value, agreed value. Then credit capital, Megatron capital 450,000 corresponding lang doon sa kanyang investment. Okay? Then Starscream capital corresponding lang din sa kanyang investment na land, which is 250,000. No other liabilities assumed, so assets is 400,000. So liabilities 0, so capital is 400,000. Equal pa rin ang basic accounting equation. Next, non-cash investment with book value only. So meaning, of the agreed value, only book value is present. So Megatron pa rin and Starscream form partnership. 150,000 cash kay Megatron. Si Starscream naman, invested land with book value 200,000. The important thing here to only assume the book value is that the two last statements. The land has no readily determinable value in the market, and the partners agreed to have it at book value. Okay? So the journal entries being required for the formation. Necessary solution, cash investment, again, always at face value. Kung ayaw mo na sa mukha ko, tignan mo mukha mo. Joke lang. So non-cash investment at agreed value, always at agreed value. They agree to value it at book value. So Megatron's cash, 150,000 face value. Starscream's land, since book value ang present, we have it book value. So 350,000 total investment. Okay? So, journal entry, debit tayo ng cash, 150,000. Debit tayo ng land, 200,000. Then, Megatron Capital, credit, 150,000 corresponding sa kanyang investment. Then, Starscream Capital, 200,000 corresponding din sa kanyang investment. Okay? So, assets, 250,000, wala namang liabilities na inassume. So, zero liabilities. Our capital is 350,000. Okay, balance pa rin ang basic accounting equation. Next, with liability assumed. So, Megatron and Starscream ulit, kakasawa na. Pero yan yung next example eh. So, form a partnership, Megatron investing cash, 150,000, Starscream invested land with fair value 250,000, and book value 200,000. The partners agreed to value the land at fair value. So, may agreement, fair value. The note payable amounting of 100,000 was attached to the land. So therefore, the investment of Starscream, the land, there is an attached obligation, a note payable of 100,000, and the partnership assumed the liability. That is the important phrase in the problem when it comes to the consideration of the liability or the assumption of the liability. Okay? So the partnership assumed the liability. The requirement is journal entry. So necessary solution, cash investment always at face value or actual value. Non-cash investment, have it at agreed value. Then the liability assumed, have it at the assumed value. Okay? However, there are some problems that will revalue liabilities if the liability has given fair value, always assume fair value. If the liability walang assumed fair value, then always consider the assumed value of the liability. So, Megatron's cash, 150,000. Then Starscream's land, 250,000. Then Starscream's note payable, deduction, yung 100,000. So, yung magiging net investment ng partnership is 300,000. Okay? So, to have it in journal entry, we have to debit cash, 150,000. Then we debit land, okay? Debit land for 250,000. Then credit note payable, okay? Because the liabilities has been assumed by the partnership. Note payable for 100,000. Megatron capital for 150,000, corresponding sa kanyang investment na 150,000. Then Starscream capital, because Starscream meron siyang related liability at the moment of formation, then yung i-credit lang na capital sa kanya is 150,000, which is the difference of the 250,000 and the note payable of 100,000. So assets 400,000, liabilities assets 400,000, liabilities 100,000, net capital is 300,000. Okay? So I hope nakita nyo. You've been naging familiar kayo sa difference ng mga problems. Okay? Basic lang naman 'yon. Basic valuation, basic assumption, basic computation, basic journal entries. Let's proceed with partnership formation, individual plus sole proprietor, meaning merong business owner. Okay? There's an accounting procedure here because it could either be formation of new partnership book or retention of a sole proprietorship book as new partnership book. Okay? So first, we can assume there is retention of the sole proprietorship book to be used as the new partnership book, or the partners can agree to form or to open a new partnership book. I-chapera na si sole prop na book. Okay? So let's try. Problem. Okay. Megatron and Starscream decided to form Decepticon partnership. Talaga parang Transformer talaga eh. Megatron, an ordinary individual. So, ordinary individual lang daw. So, ordinary individual dito si Megatron. Okay, is to invest cash for 450,000. And this brand new delivery truck brand new delivery truck with a purchase price of 100,000, which they agree to value it at that amount. Starscream, a proprietor, so business owner, is willing to invest his business to the partnership. The following pertains to the business of Starscream. So merong information on the business of Starscream. Meron tayong chart of accounts with corresponding amounts. So 200,000 cash, 300,000 accounts receivable, 160,000 land, then building 500,000, accumulated depreciation sa building 150,000, account payable 100,000, note payable 250, at saka Starstream capital, net ng lahat, we have 660,000. So let us continue the problem. They decided to have the following adjustment. Ito yung mahirap pag ganito yung problem, meron tayong involvement ng isang business owner because adjustment are involved. Okay? So just follow. They decided the following adjustment. An allowance for doubtful accounts must be established 5% of the accounts receivable. So therefore, gagawa daw tayo ng contra accounts receivable account, which is allowance for doubtful accounts. So gagawa daw tayo ng allowance for doubtful accounts in relation to accounts receivable, which is 5%. Okay? Then land of Starscream must be valued at 40,000 higher than the recorded amount. The land earlier is valued as at 160,000. So i-value daw natin siya plus 40,000. Why plus 40? Because 40,000 higher. So plus 40 probably and exactly magiging 200,000 yan. Then accrued expenses of 10,000 should be recognized by Starscream. So walang accrued expenses on the chart of accounts. Kailangan daw mag-adjust. Recognize tayo ng accrued expenses ng 10,000. Okay? So the requirement, prepare the journal entry to for the formation, assuming yung book ni Starscream i-retain, gagawing new partnership book, and second, magde-decide sila to open a new partnership book. So i-chapera yung number 2 sa yung Starscream book. Okay? So assumption number 1, Starscream's book will be retained and used as new partnership book. So the following step must be followed. So adjust first all the assets and liabilities of the sole proprietorship as agreed upon by the partners. The capital account of Starscream will be used for the adjustment. So in incorporating the adjustment to the assets and liabilities of Starscream, the capital account will absorb the adjustments. Okay? Then record the investment of Megatron. Since i-retain natin yung book ni Starscream, yung magiging procedure lang is to adjust the liabilities and assets of Starscream, then i-record diretso sa yung investment ni Megatron. Okay? So first, debit tayo ng land for an increase ng 40,000. Then i-eliminate natin yung accumulated depreciation ng building. Guys, when we have it in the formation, when we say partnership formation, it is a fresh start. So when we have fresh start in the formation of partnership, kailangan walang contra asset account yung properties. Okay? So yung present na contra asset account ng building, which is the accumulated depreciation, kailangan tanggalin yan. Okay? Kailangan tanggalin. Okay? So, i-charge natin yan as a credit to a building account para ma-eliminate si accumulated depreciation. So, later, yung building mababawasan na ng 150,000. Then, credit tayo ng building for 150,000 in relation to a debit to accumulated depreciation. Then, credit tayo ng uncollectible accounts or doubtful accounts or allowance for doubtful accounts. Computation niya is 300,000 accounts receivable times 5%. Kasi 5% naman sabi kanina. So, 15,000. Then, i-recognize yung accrued expenses. Okay? I-recognize yung accrued expenses for 10,000 credit. Then, credit tayo ng Starscream capital to absorb the net adjustment. 15,000. Okay? Why not adjustment of 15,000? 40 minus 15 minus 10. So that's 15. Okay? Then record the investment of Megatron. Okay? So debit tayo ng cash for 50,000. Debit tayo ng delivery truck 100,000. Then credit tayo ng Megatron capital 550,000. All of these entries will be present dun sa books ni Starscream as the partners, a new partnership book. Okay? So, after the formation, ito yung magiging magiging tawag nito, balance sheet or statement of financial position. So yung cash, wala na mga adjustment, assist pa rin. Accounts receivable, babawasan na ng collectible accounts, maging 285 na lang. Then the land as is, then yung building kanina na 500, tinanggalan ng accumulated depreciation, then charge sa building, 350 na lang. Then delivery truck of Megatron, ayan, 100,000. Yung yung 650 na yan pala actually, hindi nagalaw yung walang adjustment sa Starscream cash, pero merong additional cash kay Megatron. Kaya pala naging 650,000 to. Accounts payable, walang adjustment. Accrued expenses, i-recognize to. Notes payable, wala ring adjustment. Then meron tayong bagong capital, Megatron capital, 550,000. Then the adjusted capital of Starscream, we have 675,000. After the formation, kailangan the same ang kanilang balances ng total assets and total liabilities and partners capital at 1,585,000. Okay? Assumption 2. Paano naman pag may assumption 2? Sa assumption 2, sabi niya they decided to open a new partnership book. So mag-open sila ng new partnership book. So following step, we have to follow. First, adjust all the assets of the partnership, of the sole proprietorship as agreed upon by the partners. Then capital account of Starscream will be used as absorber of the net adjustment. Then close the book of Starscream. Because we are opening a new partnership book, we have to close the book of Starscream. Okay? This is the difference pag nire-retain mo yung old sole proprietorship book para gawing partnership book at saka versus dun sa pag-create ng new partnership book. Talagang fresh start talaga. So close the book of Starscream, then record the investment of Starscream, the assets and liabilities at adjusted amounts. Okay? Then record the investment naman ni Megatron. Yun yung magiging last step. So to do that, okay, the same journal entry that we have earlier for the adjustment, okay, so parang copy-pasted lang to. And the additional journal entry that we have is to close the books of Starscream. To do that, the asset accounts must be credited, and the contra asset accounts and the capital and the liabilities accounts must be debited. All in the adjusted amounts na. Then after closing the books of Starscream, we have it i-record naman pabalik dun na sa partnership books. Parang i-reverse mo lang naman. Okay? Then number 4, yun na, i-record mo na yung you're going to record na the investment of Megatron. So this simple lang naman. 400,000 debit sa cash, 100,000 sa delivery truck, tsaka kay Megatron capital 550,000. Okay? So that's it. So after the formation, ganyan yung magiging itsura. Okay? New Decepticon partnership book. Kanina yung Decepticon balance sheet, referring yun dun sa old sole proprietorship book na ginawang partnership book. Dito naman, referring sa new partnership book. Okay? So, ganun pa rin naman yung itsura ng statement of financial position. Wala naman akong binago. Yung assumption lang naman ng accounting yung binago. Okay? But at the end of the day, the same pa rin naman yung kalalabasan niya. So, partnership formation, we have to consider yung tinatawag na bonus method at saka goodwill method. Okay? Meron ba ganyan, sir? Meron. So let's start with bonus method. Bonus method, okay, partners agree to different capital interests without recognizing any asset. So parang nag-a-adjust lang sila dun sa capital nila. Okay? The total agreed capital is equal to the total contributed capital, though the capital credit to each partner may be equal to or greater than or less than to his capital contribution. So meaning, sa example natin kanina kay Megatron tsaka Starscream, they can agree to make adjustment on their capital accounts without distorting the total asset. They can have equal agreed at saka contributed capital, but the credit to their capital account is different, maybe equal or different to their investment. How do we apply this one? So let's have an example. After determining their adjusted capital balances, Megatron and Starscream decided to receive equal capital interest or 50 a ratio of 50-50 between them without recognizing any asset. Kung makikita nyo, yung capital investment nila is good for 550,000 kay Megatron at saka 675 naman kay Starscream. So magkaiba yung kanilang investment. Pero yung kanilang capital credit na gusto, equal. So paano yan maging equal? Ayan, since Starscream has the greater capital than Megatron, to meet the 50-50 ratio, kailangan capital credit tayo kay Megatron. Saan kukunin yung capital credit na yan? Mula kay Starscream. Okay? So, i-total mo, 675 plus 550,000, magiging 1,225,000. Yung 1,225,000 i-divided by 2. So, equal 612,500. To have the capital accounts at 612,500, bawasan si Starscream kaya nga dinebit yung capital niya, then dagdagan si Megatron kaya credit ang capital. Okay? Yan. Magiging equal na at 612,500. Okay? So that is bonus method. Next, goodwill method. Partners agree to a different capital interest by recognizing goodwill. So kung kanina yung bonus method, walang asset na nire-recognize, dito meron. Meron tayong asset na nire-recognize which is goodwill. Okay? So how do we do that? Total agreed capital should always be higher with the contributed capital. Okay? So meaning, kung ano yung i-invest ko, kailangan yung agreed capital na i-credit sa akin is greater than my contribution. So how do we do that? So after determining, let's have an example, after determining their adjusted capital balances, Megatron and Starscream decided to receive equal capital interest, okay? 50-50 daw by recognizing goodwill. So, nirecognize nila ang goodwill, 50-50 pa rin. They want 50-50 kahit magkaiba yung kanilang capital balances or capital investment. Okay? Gusto nila ng 50-50 pero they don't want or they want to recognize an asset which is goodwill. Okay? So, how do we do that? Since Megatron has the lowest capital credit, siya naman yung merong 550,000, para sila mag-equal sa 675 para mapantayan niya si Starscream, kailangan mag-recognize siya ng goodwill, which is the difference of 675,000 minus 550,000. So yung 125, i-debit natin sa goodwill, then dagdagan ng capital ni Megatron, 125,000. So para mag-total sila nasa 675,000. Okay? So parang medyo madali pa naman pag tawag nito, partnership formation. Okay? So stay tuned pag pumunta na tayo sa partnership operation. So let's continue. So partnership formation of two sole proprietors. Basic concept na lang ako dito, basic procedures. So how to account? The same goes doon sa may involvement ng sole proprietorship. When we account for formation of two sole proprietors, there could either be retention of one of the sole proprietorship book as a new partnership book, or the sole proprietor may agree to open a new book. Parang the same pa rin lang naman. Okay? So for retention of sole proprietorship book to be used as new partnership book, okay, need muna i-adjust ang asset at liabilities, okay, of the sole proprietorships into the agreed amounts, into the agreed adjustments. Okay, their capital accounts are the respective absorber of the adjustment. Then close the book of the sole proprietor na hindi gagamitin yung kanyang book as partnership book. Then i-record yung investment ng dalawang sole proprietor dun sa ni-retain na book. Okay? Kapag naman gumawa tayo ng sariling ng bagong partnership book, ganun pa rin, i-adjust mo yung assets and liabilities to agreed amounts, then use the capital accounts to absorb all the adjustments. Then, yung pinagkaibahan lang ng kanina, since walang book na gagamitin, we have to close all the books of the old sole proprietors. Okay? Then, create a new partnership book, then record the investments on that new partnership. Actually, balikan nyo lang yung procedure kanina. Yun na yun. So, that's it with our partnership formation. I hope you have learned something with this discussion. So, stay tuned with our discussion for partnership operation. So, that's it. Thank you.